Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, we'll be covering 5 key principles that Warren Buffett follows to identify the best companies for investment. Buffett, as most of you may know, is a legendary investor and third richest person in the world. He is both a savvy businessman and a very generous philanthropist. Buffett has followed and extended the Graham School of value investing. Value investors look companies with prices that are unjustifiably low based on their intrinsic value. There isn't a universally accepted way to determine intrinsic value, but it's most often estimated by analyzing a company's fundamentals. Some of the companies he is invested in are Apple, Coca-Cola, American Express. So let's dive in. Number 1. Company performance. To determine companies' performance, Buffett looks at return on equity. This is also referred to as the stockholders' return on investment. It's the rate at which shareholders earn income on their shares. Buffett always looks at ROE to see whether a company has consistently performed well compared to other companies in the same industry. ROE is calculated as net income divided by shareholders' equity. But looking at the ROE in just the last 1 to 2 years is not enough. We must review the ROE from the past 5 to 10 years to analyze and understand historical performance. Number 2. Company debt. The debt-to-equity ratio is another key characteristic that Buffett considers carefully. Buffett prefers to see a small amount of debt so that earnings growth is generated from shareholders' equity as opposed to borrowed money. This ratio shows the proportion of equity and debt the company uses to finance its assets, and the higher the ratio, the more debt, rather than equity, is financing the company. A high debt level compared to equity can result in volatile earnings and large interest expenses. Number 3. Profit margin. A company's profit depends not only on having a good profit margin, but also on consistently increasing it. This margin is calculated by dividing net income by net sales. For a good indication of historical profit margins, investors should look back at least 5 years. A high profit margin indicates the company is executing its business well, and increasing margins mean that management has been extremely efficient and successful at controlling expenses. Number 4. Is the company public? Buffett typically considers companies that have been around for at least 10 years. As a result, most of the companies that have had their initial public offering IPO in the past decade would not get on Buffett's radar. He says that he does not understand the mechanics behind many of today's technology companies and only invests in a business that he fully understands. One important point to remember about public companies is that the Securities and Exchange Commission, SEC, requires that they file regular financial statements. These documents can help you analyze important company data, including current and past performance, so that you can make more important decisions. Number 5. Is the company cheap? This is the most important one. Finding a company that meets the other criteria is the starting point, but determining whether they are undervalued is the most difficult part of value investing. And it's Buffett's most important skill. To figure this, an investor must determine a company's intrinsic value by analyzing a number of business fundamentals, including earnings, revenues, and assets. And a company's intrinsic value is usually higher and more complicated than its liquidation value, which is what a company would be worth if it were broken up and sold today. The liquidation value does not include intangibles such as the value of a brand name, which is not directly stated on the financial statements. Well, Buffett's success depends on his unmatched skill in accurately determining this intrinsic value. While we can outline some of his criteria, we have no way of knowing exactly how he gained such precise mastery of calculating value. For now, that's it from us. Hope you learned from these principles, and let us know your thoughts in the comments below. Thanks for watching, smash that like button and subscribe for more.